Hi, everyone. I'm Rick Bensignor. Today is Tuesday, September 28th, and welcome to this week's In the Know Trader Show. What do we have on tap this week? Well, we're going to start off with our trader education portion. We're going to talk about respecting history. In our markets overview, we'll take a look at the Dow and the US 10-year. And then this week, we'll take a look at the financial sector. We haven't looked at financials in 2 months. And they are certainly been on the move, with rates having moved significantly higher, all very good for banks and those who make money on the spread between loaning and borrowing short-term and loaning long-term. So we'll take a look at these dozen names or so. So that's what we've got on tap for the show. If you're interested in signing up for my weekly or monthly products, we've got a weekly ETF tactical trade report, comes out generally on Thursday nights. It gives a good macro overview of much of the marketplace, plus gives you a brand new ETF trading idea for each week. The intended holding period on that is usually weeks to a couple months. And so it is not for long-term investing. Occasionally we get one that we keep riding, but usually we're more into the kind of swing trading and couple months type time frame for holding. And the other thing we come out with is at the end of each month, on the last day of the month, we come out with a brand new 7-11 monthly spider sector report. And this, the goal of this report is to outperform the S&P, which is very different than the weekly tactical trading report, which is a trading oriented one. Here we go through the 11 spider, macro spider ETFs, in other words, like XLK, XLB, XLE. Each one of the 11 that lines up with one of the S&P macroeconomic sectors, and with the goal of outperforming the S&P by being in no less than 5 of the 11, or ever more than 7 of the 11 at the same time. And as I've said to you before, after our first year of performance, we outperformed by 261 basis points, or 2.61%, which is a great start, and goes to the point that we have a process, we have methodology, we have a way of being able to outperform the market, which of course most people cannot do. So if you are an individual investor looking to do better than just simply being long the spiders in your account, or if you're a financial advisor and you want a good way to show your clients how much value that you can bring them, then this is the way to go, and subscribe to the 7-11 monthly report. All right, let's just take a look kind of what the sectors are doing year to date. Energy, the big outperformer. It has materially advanced over the last few weeks. Now, it's always been right near the top, either the best performer of the year. Over the last couple of weeks, real estate actually slid ahead along with financials, but energy has taken a huge surge in the last month. And in fact, it was mid-August when I upgraded the sector to go full overweight, and that has been a home run. Now, of course, the energy sector still only represents 3% of the S&P. So even though we had a full double weighting, and we're along 6%, in our 7-11 portfolio, it's still the type of thing that, because it's such a small piece of the S&P, it doesn't make a huge difference to the bottom line, but nonetheless, we caught that perfectly. I also upgraded financials in mid-July, caught the bottom on that, and that's, in the last 2 months, financials and energies are by far the biggest outperformers. So we did, both in that portfolio, and those subscribers who follow know that those are 2 big changes, and we've done really well with those. So you just take a quick look at this. You see energy, financials, real estate, the bigger outperformers, staples and utilities, the big underperformers, and then everything else kind of either side of where the S&P is, which coming into today was up 19.55% on the year. All right, so let's go back here and just talk a little bit about respecting history. What do I mean by that? Well, certainly it pays to respect history throughout all facets of your life, not just the markets. But today we're going to focus on specifically how it relates to the market. So what's it mean to respect history? Well, if something was, let's say, a previous high, a significant high, or even an intermediate high, those levels, when revisited, often bring in sellers against what was a prior high for no other reason than the market previously had difficulty getting through that level. It may very well have trouble getting through it again. For what reasons? It may or may not be the same reasons when versus the last time we were there, but there is a psychology of if the stock had gone up to 80 and down and it comes back near 80 again, you're going to find some natural sellers because the market has a history of coming back to test prior important resistance levels, and the same thing for support. How do you get a triple bottom? Well, because first you had a bottom, then you tested that bottom and it kind of held that same level, then you rallied, and now you've come back a third time. Now, some people don't believe in triple bottoms. They'll say the triple bottom's ultimately going to break, but I've seen many times that we've seen 3, 4, 5 times at the same level. So there is value in knowing where these kind of important transitional levels have been in the past, and you need to respect them because a lot of times people anticipate a breakout and the breakout never happens, or to say the word never, it doesn't come when you think it will, and a stock stalls where it did the last time it got up there. And for the next 6 months, it's down before maybe you get a chance that it breaks through again. So it's important to know and to kind of respect history. And in the case of history, it's what's happened before to this particular name or to an index. It's why people will say, well, historically, September is the weakest month of the year. Well, you can just look back 100 years, look at the data, and it'll show you that September is the weakest of the 12 months over time. Does mean on any given year it's going to be the weakest month, but over time it has been. So people know that. So there's a seasonality effect that often comes in. And, we saw a big decline a week ago Monday. Today, as we record this late morning, the Dow's down about 450 points or so. It's another sell-off day. It's not like we saw a couple of weeks ago where it was down 1,000. But there are certain things that you expect in September to happen. Why? Well, because they've happened before, and history has a tendency of repeating itself. Human beings tend to make the same mistakes in the year 2021 that they did in the year 1521. Human beings tend to do things repetitively, even though they don't necessarily notice it, but history tends to repeat itself. And therefore, when you observe the markets, you want to know historically what has happened, whether it's this month, whether it's this season, the quarter, what has gone on before. Why is there certain things called the January effect? Well, because it's happened so many times that things have repeated itself. So I like to look at charts also in a way of understanding what has happened in the past, what signals worked when a market actually found its ultimate high or ultimate low. Those tend to repeat over time. And I often find the inverse the same. So if I find a particular signal that helped nail the bottom, it often will take until that signal shows up on the top before I believe that we've actually topped on something. So in the way I analyze markets, I respect history. And I want to show you something here. And I don't usually show you guys my thoughts on the S&P, but I want to show you, let's see. Let's take a look at the S&P on a monthly chart. Now, this is not up to date in the sense that I just want to show you something and then we'll bring it forward. If I look at notice where the all-time highs were in 2007. basically the same thing as the all-time highs in the early 2000s. Look at where we sold off to, right? We exceeded the low. There was a triple bottom here back in 2002, 2003, right down here in the S&P, just between 750 and I don't know, about 800. Then we sold off, so pretty much equal highs, made a slightly higher high, but again, knowing if you look back, you know that that's a place the market's going to test. And look how long we spent 6 months up here. This is a monthly chart. We spent 6 months, at least 6 months, kind of playing with the old highs. What did we do down here? We sold off in November of 08, pretty much same place we had the triple bottom. We rallied a little, sold off one more time into the March 09 bottom. Technicians who weren't savvy enough to realize that this was a very temporary low. I can't tell you how many people I know who consider themselves good technicians that said, oh, well, once we took out that triple bottom, we're going way, way lower. Well, no, we had one monthly close that was lower. Even the month of March, the one that made the lowest low down to 666, right, closed back above that level, and then we just zoomed higher. And a lot of technicians kept fighting this and fighting this. Those of you, well, most of you listening to this will not have known me back then in the work I did, but Jim Cramer on CNBC, quoted me on March 9th or March 10th, I forget which day was the absolute low, but we went long at 668 in the S&P. So in theory, we bought the absolute bottom to the market, as I did in 2002. So we bought this low too. It really pays to know what's going on. So here's the S&P. What happens? We get back up to those old highs, and this time we go through. And where do we get to? Well, if I measure the decline from what had been the all-time high to the low in 09, and use that as the basis, 100% retracement takes us back to the old highs. Use Fibonacci extensions, 1.618 times this move gets you to 2138. Look how many months we stalled against there. Sold off with a big sell-off in 2015, the fall of 2015 into early 16, right? And then eventually we break through. And where do we go next? Well, 1.618 times 1.618 is 2.618. What do we do when we get to 2.618? We essentially stall here for months. Again, respecting, now this is a new all-time high, so I'm not respecting the level as if this was, previous resistance, the way the 07 high was the same as the March 2000 high. It respected the fact that this Fibonacci extension meant something and stalled for months. Eventually, it breaks through. And then we get to 2020. And this is early 2020, and the decline, right, to the March 2020 lows when COVID first hit. And notice that this came down almost, not exactly, but almost to the same place it had broken out from, and this important Fibonacci extension number. Then, of course, we know since March of last year, the market has just rocked to the upside. We took out all-time highs and then just kept going. So what is 2.618, a Fibonacci extension, times 1.618, the golden ratio? So the same way we got to 2.618, which was 1.618 times 1.618, now we're going to do 2.618 times 1.618. And that comes to 4.24. That's the calculation. Where's 4.24? 4.24 times that move, as you can see here, 4.24 times this S&P 4,522. Essentially, the all-time high, right? We got 20 S&P points above there, and we've pulled back. Now, do I think we're pulling back down here towards 3,000? No, I don't, not at all. Have I told clients that there's a good likelihood that the S&P will not progress for the balance of the year. Yes, that's what I told them. I think we go basically sideways for the rest of the year. Why? Because the last time we hit one of these lines, again, I'm respecting history, we stayed for 4 months before we broke out. The time before we hit this line, we hit it months and months. It took about almost a year, or actually it looks like it took a year to break through. So I have sold a fair amount of my S&Ps, my spiders that I've had for years. And I'm not a bear. I'm not looking for a huge decline, but I am looking for a consolidation here such that I can buy these back. Hopefully I can buy these back better than I sold them for. And that's all part of respecting history, knowing what to look for, and then playing it when you see it. Now, some will say, Rick, just raise your stop. Well, okay, so let's say I'm long and I don't want to sell out of any of these. Where's my stop? Well, you tell me. You tell me which level in this big up move that we had since March of 2020. So in the last year and a half, where are you going to stop yourself out that makes you think that you're going to be able to pick the level that if it breaks beneath, it's going to mean we're going lower? I'm not sure where that is. Now I can do analysis and come up with other things to try to define that. Or when I hit a level that I think is really important, I can sell before giving back a whole chunk of money. So if I stop myself out, let's just come up with some level. I don't know, I'm arbitrarily picking this. And I say, if it breaks under here, I'll stop out my long. Well, I've now given back 500 S&P points before I stop myself out. Now, if I got out too soon and this kept going, yep, I'd have to pay more than where I sold them out. But the difference is I have a plan and I sell into strength versus selling weakness. If you're a long-term bull, then selling weakness is not really what you want to be doing. You want to sell strength where you think you can find the absolute or something darn close to what the high is going to be, with what you believe are much better than even chances to be able to buy those back at a better level. And so that's what I've done. And that's the type thing that I wanted to show you again. I usually leave all my thoughts on the S&P to clients only, but I thought that this is something that you could understand and know how to use and take advantage for yourself to just understand the concept of respecting history and playing levels that should mean something based upon the past. And to me, spending 4 months here back in 2019 and a year here between 2015 and 2016, all basis what the decline was from 07 to 09's low. And this obviously was a huge down move at the time, right? This is the whole great financial crisis. Then we can certainly say that the 09 low is a very logical and smart place to make extensions and observations from. So that is that's our trader education portion. Let's quickly get to let's take a look at the Dow. So now we're into weekly charts. We've broken last week. We actually broke beneath, held this 33,740 level, the TDST line, closed back above it, but we're back down through it again. We're on a 4 count down. So I'm in no rush to do any significant buying. Notice right down here near 33,000, we have two trend lines coming together, and the propulsion level at 32,792. Much better place that if I'm going to do some buying, I would look to do there. TNX yields are on the move. Here, we'll take a look at the weekly chart first. Clients know that I sold out of virtually my entire bond portfolio on this pullback right into here. I've been bullish yield since. This is the TNX, so this is the yield chart. You'll notice that we're stalling against the trend line that we had in place from August of last year. So wouldn't surprise me if in the low 150s, we take a breather here, but it's still, this still essentially targets something near 1.64% as the target for this move up. Bigger up targets are near I'm trying to remember, I think it was 1.86 is my bigger target on the upside. All right, now I think that was what we're going to look at as far as just macro stuff. Let's take a look at now the financial sector. So first thing we're going to do is just take a look at the XLF versus the S&P. This in the summer, in mid-July, I upgraded financials. In the no trader clients got that call. So not only did we call for the pullback in yields up here, basis the oldest low, what had been lows, plus the fact that we had a weekly 13 here on the upside, potentially calling for trend exhaustion, but we nailed this bottom in here, which if you take a look, I could here, let's do a little rectangle. So just from the purple line here down to here is your, what I call your Fibbo box, right? That's your 38 to 62% retracement. So I had pretty high confidence that yields were in fact going to bottom into here, but look at where the old highs were, here, and look, we came right back to it. I got out of my bonds at 1.15% is where I sold out. So that was the bottom, and in relative terms, you can see how great a call that has been. Having picked the bottom here. And we told you a couple of weeks ago, we picked the bottom in energy too over the summer. So mid-August, we upgraded energy. So this is why if you like playing sectors and stuff, this is why you also want to be in the 7-Eleven report, because this is where we're going to call for all major changes in sectors. Okay, let's get to individual names. We've got about 6-7 minutes to go. We'll rip through as many as we can. We will start with, let's see, did I put it up in here? Here we go. All right, so we'll start with Berkshire Hathaway, and we'll just make our way through. We're on a 5 count down. This is the 5th week in a row. The close is less than the close from 4 weeks prior. Now this week's not done. There is some support right here. This is the weekly baseline in orange. We have not been beneath it on the whole rally up. So right now, this week's high is the conversion line from the cloud, and right now the low is the baseline. Close underneath the baseline with any significance, and it makes me think there's a better chance this can get down to 258 or so over the next several weeks and potentially finish out a 9 count, in which case I'd probably be looking to buy again. JP Morgan. Different picture, stronger, actually made new, this is all-time highs, I think it is. Yep, so this week making new all-time highs. Gapped above the propulsion bullish, this would be a bullish propulsion level, but last week was an up close, so it's not qualified and confirmed, but a continued rally targets 172 and change before the mid 180s on the downside. Look for continued support in the low 150s. Bank America, BAC. Okay, so now we've got a weekly 13, pretty much the same level the last time we had a weekly 13. So that doesn't mean I have to sell it here, but now I'm on alert for a potential flip over the next couple of weeks. Should this turn down. Now, banks are on the move, and again, higher yields are great for banks, so I'm not going to step in front of this yet. But I'm certainly going to pay attention to what last week's low is, and I don't want to see it get beneath last week's low. On the upside, targets are 49.25, and then all the way up at 62 if you have a massive rally to the upside. Wells Fargo got some trouble this week. Mess of 13s over the last 6 months. I'm not a particular fan of it. I think this can get all the way back down towards 40-ish. Morgan Stanley. All-time highs. Let's see, did we make a new one this week? 105.95. If not, darn close. Yeah, looks like so. New all-time high. We are in the low of the week. In a big picture, you want to see this stay above 91-ish, where the baseline is, right? So we've been beneath the conversion line a few times. but we have not been beneath the baseline. So certainly you've got 10% downside versus 10% or so upside. You could go either way here, depending upon what you think, but I would stay with the trend until it's not working. Citibank or Citigroup, better said, topped on weekly 13s. Notice here, this bottom 13 that called for a buy. Now it's on a 13 back in June, hasn't progressed since, has properly held the bearish propulsion level at, let's see, where's that level, 67.5. Again, could you lighten up and take a little off and play for a move down here? You could. Not a terrible thing to do. It just depends on, if it's a lot easier selling stuff out of an IRA and not paying taxes on it than you would if it was in a taxable account. So I look at those differently when it comes to trading and which ones I'd rather take profits in. Excuse me. Goldman Sachs got up to 420-ish or so. It's pulled back down to 391. It is in a down count. Notice too, this has not been beneath the orange line on the whole way up. So 372-ish is an important level. If it gets under there, I'd look for it to come back down to this level here, where these other lows were near 350. BlackRock, straight down over the last 5 weeks. Now, this is not a pure bank, right? So they're asset management, largest asset manager in the world. But coming back and let's, I want to rectangle, I want a trend line. So let's come here. So here's the recent lows since May. We're a little above there. I'd even give it room down to maybe even 824. Wouldn't want to see it get much beneath that, or it will head down to the top of the cloud. American Express. Basically has held the all-time high in this rally. You can see it's got a trading range over the last couple months, stalled again this month. If this week closes less than 175.72, and then next week closes above these highs, look for it to extend all the way up to 201. Otherwise, it's still in the trading range, and it'll probably come back down to test 160. Charles Schwab. New all-time high this week. Certainly has a banking component, even though it's also an asset manager. So it did make a new high. It's back underneath that. That is important. If we stay down here, then it certainly can come back to the lower part of the range. So I kind of be interesting to see come Friday which side of, if we're above all-time, what had been the all-time high or not. Upside targets are just barely higher at 78.5. 81 and change, and then almost 91. SPGI, which is S&P Global, 13. There's a 13 in here on the top. Now, this has had lots of 13s along the way, but this week is certainly a trendy week. Last week was an up close on the Friday from the relative one, which means if we close underneath 424.90 this week, gap down lower next week, it's probably a sale. PNC, new all-time high. Oh no, actually not. Stalled against. So here we are. If this breaks out, you're looking at 207, eventually 238, but it hasn't broken out yet. So watch how this closes on Friday. And the last one we'll do is the Chicago Mercantile Exchange. Not an asset gatherer per se, right? An exchange tends to do better as markets sell off, get more volatile. This does have a confirmed propulsion sell signal here with a target down at 175. Has some minor resistance here, stalled against highs from back there. So wouldn't surprise me if we go a little lower. That's it for this week. Hopefully you understand and get some value from respecting history. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.